Good morning, friends, and welcome back to another video from the Money World. In the last few sessions, we saw a few stocks where you could invest. In today's video, we are going to see a little bit about mutual funds. So first, let us see what are mutual funds, and then we'll go to an example with HDFC Corporate Bond Mutual Fund explained. All mutual fund investments are subject to market risk and fluctuations, and the channel does not assume any responsibility for investments made as a result of our recommendations. So what is a mutual fund? A mutual fund is a trust or a company that collects money from small investors like you and me and invests them through professional fund managers. Mutual funds are typically established by big business houses and big financial institutions like HDFC Mutual Fund or ICICI Prudential Mutual Fund, and they have extensive experience in handling and investing large sums of money. Besides that, they have a team of professionals from the world of finance and investing to handle those funds. So these mutual funds come up with various types of schemes which are suitable for different types of investors. And what are those schemes? We are going to see in a minute. So the most popular of these is the equity-based scheme, and this is a scheme where the mutual fund invests the money collected primarily in equities, that is on the stock market. And needless to say, this scheme can give high returns, but there is also a high risk element involved, because if the underlying shares do not perform or if the judgments go bad, then there is a risk that the net asset value of that fund will be eroded quickly. And this has happened in the past in case of few funds which took aggressive bets in new companies, and when those new companies failed, the fund also failed. So this is more suitable for those with a more risk appetite and those who have a substantial sum of money to be invested. So they can distribute it among various investments and allocate some of this to equity-based funds. The next one is a debt-based fund, which is conservative and more focused on regular income. And the investments of these funds are made in debt instruments like government securities, bonds, debentures, etc., which yield a fixed rate of interest. So when we go to the example of the HDFC Corporate Bond Fund, we will see how what kind of risks are associated with debt funds. Although the risks are low, the risks are not absent. The third one is a combination of 1 and 2. Basically, it's a hybrid fund, that is debt and equity mixed in various proportions, and various types of debt or various classes of industries in equity combined and packaged as a product. The fourth one is very interesting, and it's called an exchange traded fund, and this is useful when you are expecting the market to move substantially upwards, but you are not sure which stocks to invest in. So for example, the Nifty 50 exchange traded fund is a fund which represents all the Nifty shares in a particular proportion, in the same proportion that they form the Nifty. So if you invest in the Nifty traded fund, then it's like investing in the Nifty 50 shares individually, and if the whole market goes up by 20%, then you can expect this fund also to go up by 20%. And the last one is gold ETF, where instead of holding gold in the physical form, you can buy it in the form of ETF. But remember that ETF has certain associated costs, so these are like 2 to 3% a year, and the portfolio would be automatically losing that value in a given year. So you notice that even if the cost of gold is like 4,000 and 1 unit represents 1 gram of gold, the net asset value of the gold ETF might be slightly lower. Coming to the advantages of holding these kind of units. So for the common investor, it is difficult to achieve a huge diversification of portfolio because firstly, he is not aware about the opportunities that lie in the market, and secondly, he has a limited sum to invest. So by investing in a mutual fund units, he can actually get the benefit of diversification because the fund actually invests in a diversified portfolio. Secondly, being managed by professionals who have several years of experience in this industry, we can expect the mutual fund to be managed better than individual investments. Again, this differs from fund to fund and various judgment calls made by the fund managers. But as a general rule, we can say that the money is in safer hands in the hands of professionals. Thirdly, the fund managers make changes to their holding of the fund in response to the market trends. So they keep on shuffling the investment so that maximum returns are maximum returns accrue to the investors. Fourthly, we have tailor-based schemes. So we have different types of mutual fund schemes for different types of investors, as we saw earlier: equity-based, debt-based, hybrid, gold, etc. The next advantage is probably one of the biggest advantages, that you have a lot of flexibility in terms of the amount invested. So SIP schemes nowadays are very popular, where you can allocate a fixed sum of money every month according to your income and expenditure patterns and get some advantage or some monetary benefit by investing in a stock market. And lastly, unlike interest on bank FDs, if you invest in a debt fund, then the capital gain that accrues can be reinvested. Before actually investing, we can do some research, and there are sites like this site, Value Research Online, which gives a lot of information about the various mutual funds. So here I'm looking up the HDFC Corporate Bond Fund, and what are the things that I can look for before investing. So they have given in 4 sections: overview, performance, portfolio, and fund managers. But before that, yeah, this is a graph of, before going to the returns, here you can see that there is something known as a riskometer. And this tries to quantify the risk involved in investing in a particular mutual fund. And you'll find that for equities, it's usually high, and for funds that invest in government securities, it's usually low. But here it is classified as moderate, and the reason could be that if you see the portfolio of this fund, besides government securities, they have invested in debentures of private enterprises, so Reliance, LIC Housing, and Chennai Petroleum Corporation, for example. So these instruments are always subject to default risk because debentures are usually unsecured, and in case the company is wound up, then the holder of these debentures would not get any money. And we saw recently that a mutual fund closed 6 of its schemes because it's lost a lot of money after the COVID in some of these type of investments. So one thing that I like about this scheme is that all their investments are not only in AAA securities, but they are invested in very well-known corporations which are financially strong, like State Bank of India, HDFC, Reliance, etc. And therefore, looking at this, we can say that that is perhaps what justifies the moderate risk tag. Obviously, being a debt scheme, the returns won't be very phenomenal, but you can see that the 5-year return at 8.9% is not bad either, when currently the fixed deposit rates are hovering around 6%. Again, as we know that if you invest in the kind of reinvestment scheme of this fund, you would actually get, which is known as the growth scheme, you would not get any interest from time or any dividend from time to time, but you would get the whole amount. That dividend would be reinvested, and you would get it back only when you sell the mutual fund. So when we sell the mutual fund, it will be taxed as a capital gain and not as interest. And as we know, capital gain is taxed at lower rates of interest. So this is a fund which I particularly like, because in the current times, post-COVID, there are several big organizations, especially in industries like telecom, infrastructure, that are not doing so well, or that are at the risk of getting wound up. So a lot of mutual funds who hold debentures or unsecured debentures in these entities risk losing a lot of money. That is why we need to be careful even when investing in a debt fund, because if the capital itself is not safe, then there is no point talking about the return. So that's all for today, and hope you enjoyed this video. Do let me know your feedback, and have a nice day.